Hey everybody, this is Jim Nelson and welcome to another Euro-Pacific market update. Okay, so let's talk about today's CPI report. The numbers just came out this morning from the BLS and they suggest that inflation is not cooling. It's just one of many data points we've seen over the past few months that suggests to us that inflation is not going back to the Fed's 2% target. In fact, it's bottoming out and possibly even heading higher again. So for January, the headline inflation number was 0.5%. That's a month over month number. And that's higher than the number we saw in December, which was 0.4% month over month. If we look at the core inflation that strips out food and energy, the rate was steady. It held steady at 3.3% year over year. Okay, so inflation is down from the high levels we saw in 2022 when it peaked around 9%, but it's certainly not as low as the Fed would like to see. And from all indications, it doesn't seem to be headed down to that 2% target. Okay. What's keeping inflation elevated? One of the main things was that shelter costs continued to climb. And as we mentioned earlier last year, we expected energy prices to tick up. That's actually happened. That's feeding through into the CPI number. And a few categories like used cars and insurance, they're seeing big price swings. But overall, the trend is clear. Inflation is not going away as fast as the Fed would like to see. And you know, to be able to understand why, we have to really look at the factors that are driving this. And we've mentioned this in previous updates, but I'll go over them once more. One of the big reasons that inflation isn't collapsing is that the consumer is still spending. And the reason the consumer is still spending is there's still trillions of dollars on consumer balance sheets that got there from large government deficits during the COVID pandemic. According to the Fed, household cash balances are still way above pre-pandemic levels, and you can see this on, the Fed's website. They're way higher than they were before the pandemic, and this cash is making its way into the economy by way of consumer spending. Also, the Fed's interest rate hikes that they have done in previous years haven't had as large of an impact on the US consumer as they were intended to have. And the reason for that is that over 90% of mortgages in the US right now are fixed rate. So most consumers have fixed their mortgage rates at around 3% for 30 years. So when you're raising interest rates, it's not really hurting them because their interest rates are fixed. So the Fed's rate hikes have had much less of an impact than they would have liked to have seen. And that's one of the reasons that their rate hikes have not been particularly effective at slowing inflation. But the big driver, the really big driver here is, and a lot of people like to focus on monetary policy and talk about, higher interest rates, slow inflation, and when the Fed cuts rates, that fuels inflation. In our view, the fiscal picture, the fiscal side of the house is the most important thing to focus on. How does the government deficit look? Because in our view, deficit spending is the number one thing to watch that's going to drive inflation. And if we look at deficit spending, the US government ran a $1.8 trillion deficit in 2024. That's in a time of pro growth. And the total debt for the US has ballooned to around 35 to 36 trillion dollars. And the problem now is that the debt has grown so large that we're spending nearly 900 billion a year on interest payments. So those interest payments make up 17% of all government spending. And as long as we continue to run a deficit, we continue to grow the debt, and then the amount that we have to pay on interest rates, assuming interest rates stay the same or go up, will grow each year, and that growing deficit will continue to add fuel to the inflationary fire. So there's a number of things to look at that will support the view that inflation is not going back to 2% anytime soon. It's likely bottoming out and is going to be a persistent problem for the Fed going forward. And despite all this, most economists still expect inflation to cool in 2025. If we look some of the numbers, the Fed's forecasting PCE inflation will get down to 2.5% by the end of the year, and the market's confirming that where they're pricing in break-even rates. So the market, despite the fact that inflation is looking firm and potentially even turning up, the market still believes inflation is going to cool. So there's a disconnect in what the market believes versus what is actually happening in the economy. And in our view, this is going to come to a head in the second half of 2025. And the Fed is going to have an important decision to make once this becomes a realization that inflation is a bigger problem than previously expected. They're going to either have to keep rates higher for longer or possibly even hike interest rates, which is going to put pressure on stocks and increase global volatility, or they're going to have to admit that 2% inflation is maybe not realistic and let inflation run hotter. Either way, that's going to drive volatility in the markets in the second half of 2025, and investors need to be aware of that, and investors need to remain diversified. At Euro Pacific Asset Management, we're focusing on high quality businesses, hard assets, and inflation resistant investments. We think that's going to be the right place to be, not just for the second half of 2025, but well into the future. If you'd like to know how we're positioning our portfolios for what's ahead, you can visit us at europac.com, or you can reach out to one of our advisors today. Thanks for listening. I hope this information was valuable, and we'll see you for the next market update.